Welcome back to Everything Money. We're glad you joined us again. Today we are talking about Sony. This company is incredible, Paul. It's been around forever. They make that PlayStation. I never owned a PlayStation. Did you?
Yeah, I have. I've had.
Never
I've
bought
had
one.
PlayStation.
I was still. On,
I have one now. I just don't play it.
I was on Xbox, Sega Genesis, but Sony's incredible. People ask for this company all the time. So it's a Japanese company. It's incredible, and we're going to look at it today using our 8-pillar analysis and Paul, the stock analyzer tool, which you're previewing to viewers. Now, tell us about your love of Sony.
So, $120 billion company, 11.3 PE, check mark there with a 13% profit margin, check mark there. All right. Dividend yield, what do we call this, Seth?
This is adorable.
Adorable.
0.23.
0.23. It's like Michael Jordan, but it's $284 million a year. Now remember, folks, for those of you who are new, I preach this till I go blue in the face. A dividend is not always secure. Companies issue dividends and will issue debt to pay those dividends because they know you out there will just follow a dividend and say, oh, the company's paying it. They can obviously keep paying it forever.
Yep.
This one, $285 million. Last year's free cash flow, $7.6 billion. Last 5 years, $7.56. They can easily afford that dividend. That is a very, very secure dividend. Okay?
Perfect.
So, 2 checks so far.
Pillar number 3 is revenue growth in our 8-pillar analysis.
Last 5 years. 68 billion, 81 billion. Check mark there.
Check, please.
Love it. How about profit growth is pillar number 4, Paul?
Profit growth. 665, 10.6 billion. Check mark there.
Yep.
Something tells me that something happened here where it was really bad. I mean, look at these first 5 years of the decade. Oh boy, those were bad. What happened there, Sethy?
Well, I'm not in tune with when the PlayStations come out, but when they come out, obviously it's a huge bump, wouldn't you think?
And by the way, that's something to factor in when we do our stock analyzer tool, that you have to look at the inconsistent growth here and say, okay, there's going to be fluctuations in pricing and in profit and revenue over time.
Mo, don't you think at some point they could just make a video game like a Netflix where you don't have to own a box anymore? You just log in and play it. Isn't that the future?
So.
I think
they would just build it into your television.
Yeah.
Because isn't Xbox doing that now in PlayStation, where you just like log into a system
Nate,
and pay
do you know
them?
about this?
Don't you think the TVs would go? I mean,
My kids,
you got to pay for it somehow, right?
I don't own a box.
Well, yeah, you pay for like a subscription. Maybe it's a subscription where you say, hey, you're going to pay $100 a month and you're going to get your
All the
box and you're going to
games
get you're going to get any game you want to play.
Anyway, I'm thinking about when the hardware is going to keep coming out in the future. So keep going, Paul.
All right, so shares outstanding,
Pillar number 5.
1.26 billion down to 1.24 billion. Check mark there.
Ooh, they're buying back shares.
Not a lot. Let's not get too excited
Oh.
here. We're talking about 20 million shares out of 1.2 billion.
Okay.
Okay, so remember, this software right here, guys, I want to interrupt real quick. This software is great because it provides all the tools you need. It tells you the 8 pillars. I'm going to skip ahead real quick and just show you. It shows you the 8 pillars right here. You can do searches for the 8 pillars. Stock analyzer tool. This is 80 cents per day.
As a part of our Patreon.
Yes, and you join the Patreon, pay 80 cents a day, you get the software for free. You get the Discord with 3,000 plus members. You can talk about all investing. It's organized into 50 plus chats, 60 chats, where you can all stay organized and talk about investing and life and all that stuff. So, next.
Current assets over current liabilities, Paul.
65 billion versus 71 billion. So that's a negative, that's an X on there. I don't know if that's a consistent thing across the board. It seems to be consistent.
Okay.
Yeah.
So we know the free cash flow looked good with the 8 pillars, but tell us about it.
So again, on Everything Money software, this is not an actual line in a financial statement. We added it here for your benefit. It tells you the free cash flow. You have to do the math. 4.3 billion to 7.6 with an average of 7.5. So check mark there. 7.5 times 20. Why do we pick 20, Seth?
This is our multiple pillar number 8. This is our multiple. We multiply the free cash flow to get our desired market cap we want to pay for this.
Does this mean it's set in stone? No.
That's right.
It's a starting point, guys. If you have increasing free cash flow, growth is a big factor in what multiple you pay. The faster a company is growing, the more you should pay. The slower a company is growing, the lower multiple you should pay. I picked 20 as an arbitrary. Let's start here. Because 20 isn't insanely high, 20 isn't insanely low. It's kind of like, hey, listen, if you can find a company that's selling for 20 times the last 5 years free cash flow with good growth, you will do well, okay? So 7.5 times 20 is 150 billion. What was the market cap?
122 billion.
122 billion.
Oh my gosh,
so guys,
look
that's
at
a check mark there. And we see it here in the 8 pillars.
Oh, of course.
So if you
what
look at our
does it
8
mean?
pillars here, guys, the only X we had was something that was very consistent over the last 10 or 12 quarters, which is, so I'm looking at this saying, okay, now what's my goal here? My goal here is to go to the next steps. What's the next steps? We talked about another video going through Philip Fisher's common stocks and uncommon profits. He has a 15-point checklist, and do a skimming of the 10K. Join our Discord. Talk to other people about Sony. What do they like? Go research on the internet and see what you like. Mo here will do the charts, and then we'll go to the stock analyzer tool. We'll talk about what we have to pay for Sony.
Yeah, so Paul's talking about long-term trades of Sony. If you want to trade Sony quickly in the Bid and Ask Nation, we'll head over to Trader Mo. Mo, are people trading Sony right now? Look at that.
So they had a great run, and they went sideways for a very long time with their stochastic. And when you go sideways on top, you just keep going up in price. Now, I have to believe this is back in February, probably when the PlayStation stuff started coming out. They had gapped up. And then, of course, even with all that great news about PlayStation, that gap did fill. So I'm looking right here. You had another little gap maybe about a month ago. So I think that'll probably fill. Right now, the stochastic, it doesn't really know what it wants to do. It doesn't know if it wants to go up, if it wants to go down. So if you do eventually get buying volume in there, hopefully if you want to go long on this, you get buying volume. Red line starts to actually make a move up, and you go and fill this gap, and hopefully you can get to this 115 area or so. But this thing does have some room to run to the top side, especially with all the hype that's coming out. There's shortages of PlayStations, for sure.
Oh, are there shortages?
Nobody can get one. So
is it because of the chips?
I'm not really sure. I have never looked into it. It could be either way. When like lots of PlayStations come out, they sell out in seconds all over the place. So those days can give you these gap bumps here and there. So just keep a watch on this thing for sure.
How can you have stock going up with red bars?
The reason is because this is color coded, so you're still in a downtrend. The overall trend is still down. This just means that the trend is down. As soon as the trend changes, the bars turn green.
Gotcha.
If I go to the other chart, these would be green. The daily candles.
Okay,
it's just the way that they're programmed.
Gotcha.
Yep.
All right, Paul, what do we pay for Sony? What do we want to pay for this stock?
Okay, so we're going to go to our stock analyzer tool. We're going to make it a little bit smaller. And by the way, this is going to be even better than what I'm showing here because we're going to make it so that you can give 3 different assumptions and get 3 different prices for the stock. So we put in Sony. What does it do? It pulls up all the data right here that you need. This is actually what it's going to ask you based on. And this below is to give you other data to look at and say, okay, what are they doing here? So you're going to sit here on the left side. You're going to start with your revenue growth. Okay, it's going to ask you, give me your revenue growth assumption. Well, here it's been for the last 10 years and 1 year. 9%, 4.3 over the last 5 years on average, 3.7 over the last 10 years on average. So, Seth,
That's not too good.
Yeah, so it's increasing, right? Mm-hmm. But I think it all goes behind what are they doing with their gaming system. I mean, a lot of it, I don't know if that's true or not. I'm a value investor. I want to be more conservative than anything, right? So when I'm conservative, I'm going to put in a lower number than, I'm going to sit there and say, let's call it 4%. Okay. Shares. Now, in the last year, they issued shares, but before, in the last 10 years, they've issued shares. In the last 5 years, it's here. So one of the things I would do here is find out what the company's plan is. Okay, what is the company's plan for the future? Let's say they issue 1% more shares per year. I want to make 10%. NPV is what annualized return do you want to make on your investment? Future PE, 15. I think a company like Sony is going to do what the market does. Profit margin. Their profit margin, I mean, look at this, Seth. It's all over the board. This is a tough one. 3.4% a year over the last 10 years, 7.7 over the last 5, 13% over the last year. I'm probably going to go somewhere in the middle and call it 7%. Mm-hmm. Free cash flow as a percentage of revenue. It's been a little bit better. It's been about 8%. I'm going to put in 8% and 15 times free cash flow, and I want a 7-year analysis. I hit analyze. It's going to give me 2 prices, one based on a multiple of earnings and one based on a multiple of free cash flow. They're going to be different. Your job is to then decide what you're going to do. 68 to 78. That's what it's telling me I should pay for the company.
The current price is 97.
Okay, so it's not terribly off. Mm-hmm. But the interesting part is, if somebody went just based on PE, they would have sit there and said, oh, it's 11.3 PE, I should buy it. What the stock analyzer tool does is it gives you the actual outputs. You sit there and say, here are what I'm assuming they're going to grow with. What's the outcome going to be? I think the PE here is reflected in the fact they had a big year last year because of COVID, people staying home, playing video games.
Yep, so absolutely. This price was in this range just last October, just September, October.
Oh, really?
Yep. Just last
so I look at it saying, hey, if these assumptions are true, the assumptions I'm making are true, 68 to 78. Now, you might look at me and say, Paul, you're crazy.
Oh, I'm sorry. Keep going, Paul. I was going to say, if you pull up the max chart, it's not crazy at all, actually, when you look at the stock price over the years. Yeah.
But okay, so let's do revenue growth. Let's say you change your assumption to 6% revenue growth. They keep shares the same, 10%, 15. Let's say they keep the profit margins 8. 7-year analysis, 68 to 78 became $93. Before you know it, boom, you're already there.
So this stock price, Paul, it has never reached its high of March 2000 when it went up to $128. Since then, it has never come close to getting to it. I love when you say, if I would have told you this rising stock, Sony with all the PlayStations would have never in 20 years would not get back to its highs. It's just incredible.
Yep, and this is what happens, but this is investing. The more you pay for something, the less your return's gonna be in the future. Doesn't mean you don't ever buy something, but you buy it at lower prices, lower valuations that justify bigger gains on the road. And the good news is, if you find a company that's selling really cheap and you make reasonable assumptions and the stock is still low, it gives you an idea, okay, I gotta go look at this further, right?
Yep.
So I look at Sony saying, yeah, I'm going to look at Sony probably sub 66. Because I'm a value investor. I want to buy $1 for way less than $1. So I think it's worth 65 to 75. I want to buy it for sub 50 or something like that. But the average investor might be fine buying it for 65. And guess what, guys? These numbers can change as Sony's price. Your job will be to keep track of Sony with our software. It'll always update the financials. And that way you can make assumption differences as time goes on. Maybe something comes out that makes it rosier. Maybe something comes out that makes it worse. These are the reasons you pull the Stack Analyzer tool and do these things.
If this resonates with you, you can join our Patreon. If you feel alone out there, join the Patreon. You can join our Discord channel where you can talk about Sony. If you want to invest it, what price you want, you can get this software. It can be yours as part of our Patreon page. So, Paul, that's our take. Mo, thanks for trading that, Sony. And that's our take, guys. Fondle the thumbs up. Keep watching our videos. This might take some time. It's taken me a couple years to learn all this stuff. But, yeah, it's great work. So thanks for watching, guys. Love you. Appreciate it.